Okay, we'll start with statement of cash flow. I will explain first the statement of cash flow and the technicalities of preparing the indirect method and indirect direct method. Okay, when you prepare statement of cash flow, there will only be difference in operating expenses. Okay, when you prepare direct and indirect method, but when it comes to investing activities and financing activities, there will be no difference, no? Okay. Now, in operating expenses, we start with net income and add items not requiring cash inflow. So, meaning, these are items that increase your net income, but there was no actually cash inflow or cash receipts, no? Example is loss on sale of an equipment. Assuming the cost of equipment is 30,000, your accumulated depreciation is 20. So that means you have a net book value of 10,000. Okay, so if it was sold for 5,000, assuming only, no? 5,000. Okay, and the net book value is 10,000. Okay, so that means you have a loss, no? You have a loss of 5,000. So how will you present that? Your journal entry is debit cash, debit accumulated depreciation of 20,000. Of course, you have to remove your accumulated depreciation if you already sold the equipment. We have loss on sale of 5,000. And of course, your total credit to equipment is equivalent to 30,000. Okay. Now, this cash will go to the investing activities, no? Okay, why? The investing activities composed of, okay, purchase of property, plant, and equipment, and long-term investment. In short, these are all non-current accounts, no? Okay, there are two kinds of investment. One is income generating. Okay, like for example, if you invest in equity securities, no, or you invest in debt securities, these are income generating because the investment in equity securities are you are receiving dividend, no, cash dividends or any other form of dividend, no, for okay. However, for investment in debt securities, you will be receiving interest revenue. And the non-income generating, we have purchase of equipment, no, purchase of land. Okay, we use it in operation. So, but like for example, if you purchase equipment or you purchase land, it will not generate income, but you use it in your operation. So this will be part of the investing activities, no? Okay, and the last part, financing activity. These are sources of capital, no? Sources of funds. Like for example, when you issue share capital, when you issue share capital, that means you're issuing preference shares or ordinary shares, no? Okay, you receive cash, so your capital increases. Okay, you can also increase your funds or your capital through borrowings from the banks, no? So, assuming you have bank loan, so the proceeds will be reported here in your financing activities. So, other related transaction related to the loan, like payment of loan payable, that will be a deduction, no? That is use of cash. Payment of dividends, no? That is a use of cash. So all items related to sourcing of funds will fall under financing. Those investing activities, whether income generating or non-income generating, will fall under investing. And the operating activities, this has something to do with your normal operation. Like for example, if your business is National Bookstore, so therefore your source of income are proceeds from sale of school supplies, office supplies, and other office equipment. Your uses of cash includes payment of the salaries of your employees, payment of utilities, the Meralco, the Maynilad of the store, okay, and Of course, we have depreciation expense. So these are operating activities, no? Okay, let's go back here. The loss on sale decrease your net income, but there was no cash outflow. Why? Because no, when you make the entry, you debit cash of 5,000, you debit the accumulated depreciation of 20, loss on sale of 5, and credit equipment of 30. This loss on sale will be reported in your other income section of the balance of the income statement. This will be reported as an expense, other expense, therefore your total expenses will increase, your net income will decrease, but there was no cash outflow, no cash out. Okay, so in order to compute compute for the actual cash provided by operation, you have to add it back. Another one is depreciation expense. Why do you have to add it? Okay, so when you make an adjusting entry for depreciation, let's say 10,000, your entry is debit depreciation expense and credit accumulated depreciation of 10,000. Again, the depreciation expense will be reported in your income statement. Your income will decrease, but there was no cash out or cash application of cash. So you have to add it back. In short, all items that decrease the net income but no cash outflow, you have to add it back. Okay, how about increase in current liabilities? Okay, why do you have to add increase in current liabilities? One good example is accrued expense. When you have accrued expense, your entries debit expenses and credit expenses payable. So like for example, if you have salaries, no, you have debit salary assuming 20,000, so debit salaries expense, credit salaries payable. Okay, this salary expense will be reported in your income statement as part of your operating expenses. So your net income will decrease because your expenses will increase, but it's not yet paid. It's still payable. But what will happen to your net income? It was decreased by this accrued salary expense, but there was no cash outflow. So that is the reason why increase in current liabilities is to be added back. Okay, next is decrease in what? Decrease in current assets. One good example is prepaid expense, no? Prepaid expense. Assuming in January 1, you purchase, no? You purchase or paid insurance, no? Insurance premium, okay, amounting to 100,000, 120,000. Okay, so your entry is debit prepaid, okay, prepaid insurance and credit cash. Assuming that is 120,000 and you use the asset method, no? Okay. Now, at the end of the year, no, let's say this was purchased July 1, and that is an insurance for 1 year. So, as far as the information is concerned, no, we have used the month of July, August, September, October, November, December, 6 months. Okay. So half of that must be reported as an insurance expense, no? As an insurance expense. Okay. Insurance expense. Okay, so that is 60,000, and credit prepaid insurance. Okay, so that will be your adjustment, no? Okay, 60. So what is the effect of that adjustment? Your asset decrease, right? Because part of your prepaid insurance will be considered now as an insurance expense. The insurance expense, again, will be reported in your income statement as part of your uh, operating expenses, your net income will decrease, but there was no cash out. Look, your credit is prepaid insurance, which is a current asset section, which is current asset. So your income decreased, but no cash out or cash disbursement. So you have to add it back to compute for the actual cash provided by operation. And then you get the total, and that is you deduct items not providing cash outflow. Now, these are the items that increase your cash, but there was no cash receipts, no, or cash inflow. Okay, like for example, gain, no, assuming you you were able to sell the equipment with a net book value of of 10, you were able to sell it at let's say 20,000, no? So your entry is debit cash. Your cash will be your cash will be 20,000, okay? Credit accumulated depreciation, okay? For 20,000, okay? Credit credit equipment, the equipment, okay, with a cost of 30, okay, and the difference, okay, the difference of 10,000, okay, 10,000, that will be recorded as gain on sale of old equipment. Okay? So gain on sale. So therefore, if you sold the equipment with a book value of 10,000 for 20,000, okay, your cash will increase. But remember, equipment is classified under statement of cash flow as part of your investing. So if ever there is cash inflow, it will be reported here as a cash receipts in your investing activities. The gain on sale will be reported in your income statement as part of your other income. Okay? It will increase your income, but there was no cash receipts. Yes, there was a cash receipt of 20, but you cannot classify it as part of your operating activity because this cash is related to the sale of equipment, and equipment is considered part of your investment. So the cash, the proceeds from sale of old equipment will be classified here under investing activities, no? And the reason why we deduct gain here, okay, because, okay, it increases your net income, but it doesn't mean that you have a cash inflow. Okay, this is 12. The example is gain because these are example only. Okay. Next, we have increase in current asset. Remember, if we have sales on account, okay, let's say of 100,000, what will be your entry? Remember, your entry is debit cash, no? Debit cash, debit accounts receivable, of 100,000, okay? And your credit is credit sales. Your credit sales is 100,000 also. Look, there was an increase, no, in accounts receivable. There was an increase in accounts receivable, okay? But there was no revenue. There was an increase in revenue in the form of sales. Okay, your sales will increase, your net income will decrease, but it's not yet collected. No? So, the increase in accounts receivable, the increase in asset doesn't mean that you have cash receipts because that is still receivable. So, that is the reason why we have to deduct increase in accounts receivable or increase in asset. How about decrease in current liability? One good example of that is unearned revenue. No? Let's say you receive cash, no? Okay, in the beginning of the year, let's say 30,000. Okay, so that will be credited as unearned what? Revenue. Okay, unearned revenue is a current liability. Assuming at the end of the year, you were able to earn 20,000 of the 30,000 unearned revenue. So your entry is debit unearned revenue, okay, of how much? 20,000. So that is decrease in liability, no? That is decrease in liability. Decrease in liability. Okay, and your credit is, okay, revenue earned or credit revenue. So if that is rent, no? Okay, this will become unearned rent revenue. Okay, so if you earn 20,000 of the 30,000 debit and earned rent revenue, you have to reduce your unearned rent revenue, which is a liability, because that part, the 20,000 of the 30,000, will be considered earned. So your credit is rent revenue. Okay? So 20,000. So what is the treatment for that? So the treatment for that is, okay, so the treatment for that is, no, your rent revenue will be reported in your other income. Your income will increase, but there was no cash receipts because your debit here is not cash. It is an earned revenue, which is decrease in liability. Okay? So, in short, if your net income is 180,000, it doesn't necessarily follow, or it doesn't necessarily mean that your cash provided by operation is also 180. So like in this case, your net income is 180, but your cash provided by operation is 195. Now here again, so here in your investing activities, anything that has something to do with property, plant and equipment, or non-current assets, no? Whether it is in the form of land, building, and equipment, or investment in equity securities or investment in debt securities. When you invest, there will be cash out, so therefore that is a deduction. If you sold the investment, so that is cash in or cash inflow. Okay? So in this case, no, your cash, no, your cash provided by investing activity is negative 205. So how will you interpret that? Is this bad or good? Okay, it depends, no? Okay, the reason for the negative of investing activity is it because we purchase equipment, we purchase investment, and we purchase land. So the negative of 250 here doesn't mean bad, no? It's natural to have a negative balance if we purchase a lot of property equipment. Okay? Now for financing, when you issue share capital, that is cash receipts. When you receive loan from the bank, 200,000, that is cash receipts. That is a source of fund. When you pay your loan, that is a cash out. When you pay dividends, that is cash out. So look, no? Your cash provided by financing activity is 430,000. It is a positive and it's a big amount. How will you interpret that? Okay? So it doesn't mean that this is positive and huge amount. It doesn't necessarily follow that it's good. Because what is the source of that 430? You remember, okay, if the reason for that is we issue share capital or ordinary shares, or can be ordinary shares or preference shares, okay, and what is the negative effect of that? If you increase your issuance of share capital, no, remember the effect of that in your earnings per share. Your denominator will increase because the number of shares issued and outstanding will increase. The effect of that in earnings per share, your earnings per share will decrease. And the decrease in earnings per share would mean your shares will not be as attractive to investors, no? Because your earnings per share will decrease, no? Your denominator will increase also, but the effect of that in earning per share is decrease, no? Look, the other 200,000 is coming from loan. You paid loan payable of 30 and dividends of 40,000. So, this 430,000 is a big positive cash inflow. But look, the source is loan. Umutang ka. And then you issued additional share capital. So if you're going to get the net effect of these three, the operating, the investing, and financing activity, you have a net increase in cash of 420 and 180 your cash balance beginning. So this is your cash balance at the end. This cash balance at the end, that should be the one that is the amount of cash that will appear in your balance sheet. So again, what are the three parts of your statement of cash flow? Operating activities, investing activities, and financing activities. What if you purchase equipment, no, but you issued a promissory note? Okay, so there was no cash involved, no? You didn't pay for cash. You issued a promissory note. If that will be the case, that should not be included in your statement of cash flow. But you have to make a notation at the bottom of your statement of cash flow that the equipment was acquired through issuance of promissory note or notes payable. Okay? So, that's it. Anything that has no cash involved, whether in the form of cash receipts or disbursement, okay, that should be a notation in your statement of cash flow. Okay?